Hello and welcome to the Friday interest rate update. Hope you had a great week. So last week was inflation data, and this week focused on jobs data. So we ended the week a little bit over 7%. Not bad, not great. But the big question is, when will rates actually start to decline for real? So the answer, I think we should unfortunately get used to the current rates and get on with business. And I think consumers are starting to do this. So inflation is the key to getting lower rates. The Fed has targeted 2% as the ideal inflation rate for decades. So last week, we made little progress on the inflation front, and there are no signs in the upcoming data that inflation will drop quickly. There's just nothing there. So jobs in the economy are also a big driver of inflation. When people have jobs, guess what? They spend money. When people spend money, the economy is generally pretty good. When the economy is good, they need more goods and services, and inflation tends to increase. So this week's job figures from both ADP and the Bureau of Labor Statistics, the BLS, both came out better than expected, and the unemployment rate actually declined. So when the Fed sees this data, they surmise that inflation will go up, and it then becomes a waiting game to prove or disprove their assumption. So it could take a period of time, months, before we actually see where the economy is going. So while many of the job gains were in part-time jobs, second jobs, and lower paying jobs, it still shows growth. Thus, the waiting game continues, and who knows how long it's going to be. So unless there is a drastic jobs report showing jobs in the economy is tanking in the next couple of months, rates will likely hang out at this level for quite a while. So get used to it. I think it's going to be high sixes, low sevens. At the beginning of the year, it was projected that the Fed would make 3 rate cuts to the Fed funds rate this year. That has now been reduced to 2 rate cuts, and who knows, it might only be 1 this year. So if we can continue to see further job strength, it may only be 1 rate cut this year. The Fed is also very cognizant of being in a presidential election year. They want to maintain their non-biased, stand back approach politically. They don't want to get into that mess. Thus, as we get closer to the election, it is highly unlikely the Fed will try and make any drastic changes to their Fed policy to sway the election to either party. So as we get closer to the election, there may not be that many rate cuts. The next Fed meeting is May 1st. We're in a waiting game to hear their take right now. The good news, there's always good news for home buyers, is these elevated rates should keep home prices from skyrocketing. And while frustrating and annoying, buyers who qualify should still consider going forward with their purchase. For sellers looking to move up, they may make a little bit less money on their home now, but they should definitely save on the new purchase before prices go up when rates eventually do come down. So I'll leave you with one nugget on the potential for home values going up in Las Vegas. So California, recent report, ranks dead last in job growth. Guess who is first? Nevada is first in the nation in job growth. California is heading east, and I believe home prices in Las Vegas will continue to head north. So hope you have a wonderful weekend. Send your buyers to my calendar link below to get them pre-approved and into their new home. Hope you have a great weekend, and we'll talk soon. Bye.